Welcome to Blind Spots, a podcast where we're helping you fill the gap between what you want to do with your money and what you actually do. We are professional investors, writers, and financial planners helping you navigate the complexities of finance to optimize what you can control and cut out the rest. Join your host, Nick Shermans and Aaron Varghese, as we discuss the questions and nuances surrounding everyday money management. Hello, everyone, and welcome back to another episode of Blind Spots. In today's episode, we are going to be talking all about the differences between being rich and being wealthy. I think a lot of times these two words are used interchangeably, especially in the wealth management space as we're talking to clients. And we just want to talk about the differences today to help you define them and help you define your ultimate goal. I think a lot of people say they want to be rich or they want to be wealthy, but I think it's about defining what it really means to you.
And there's subtle but important differences between the two. And as a young person, I'm 41 now. I don't know if that's young or not, but in my 20s, I thought rich and wealthy were the same thing. Like, I want to be rich, I want to be wealthy. But once you unpack what that actually means, they are quite different. And I think from a social standpoint, it's more sexy to be rich or to appear rich, and it's more sustainable and what's the word I'm looking for? It's a longer run rate when you truly have wealth. So let's define the two. Let's first define what being rich might look like. Okay. So rich typically refers to individuals who appear to have money. They might have a high income. They might possess a substantial pot of money. They might drive a fancy car, live in a big house. And what comes to mind, if I'm tying this to like a real world thing, mortgage brokers in 2004, real estate agents from 2010 to 2021, like the money's fast. It's easy come, easy go. It's coming in at a quick rate. It's going out just as fast. And nothing against that industry, but I just happen to live in a place that people want to live, and money's been cheap for over a decade. And so I've seen this firsthand where people are living high on the hog. Once the cycle shifts, they really have nothing to show for it, just because they were living a lifestyle that appeared on the surface to be wealth, but it really was a period of success, a short period of success that defined them as being rich. So first, some might say, okay, like people like numbers around things. So U.S. household income for the top 5%, roughly 300,000. So that's, I mean, there's no official definition, but that could define somebody as rich, okay? Making a good income. All right. And then all the social media stuff that comes with it. I think that's an important component too. Like you're rich, you make a lot of money, and you have the stuff that portrays that image. Okay, now let's talk about what wealth is.
Okay, so defining being wealthy, as you said, has some subtle differences. So being wealthy is more than just about the amount of money that you have. It's all about accumulating assets and different resources that can generate income, especially for long-term financial security. So like you said, those that are in kind of those boom and bust type industries, easy come, easy go. This is thinking more about the long game. So to differ from some of the more tangible things that someone who appears rich would have, someone who is wealthy might have a diverse portfolio of investments, different forms of passive income streams. They might be considered financially independent. So if something does happen to their various streams of income, they can still sustain their lifestyle. And then we also have long-term financial planning and stability kind of along the same lines. So
right. So yeah, and that's a good definition. And the way I think about it is rich is active income, meaning you have to work to keep the gravy train going. Wealth is you can fall asleep for 6 months. You could go off the grid for 6 months. You have passive investments that are earning. It's very much passive. You don't have to work to generate and maintain your lifestyle. And I think Morgan Housel, author of The Psychology of Money and Same as Before, which I'm reading now, great writer, said it best. He said, true wealth is what you don't see. And what he means by that is we've all heard stories of the janitor that lived a frugal lifestyle, that drove a beat up car, lived in a meager house, a humble house, didn't spend on clothes, vacations, or any lavish lifestyle items. And then that person dies and their family inherits millions and millions of dollars. And they say, I never knew he or she had that much wealth.
Mm-hmm.
That just goes to show you true wealth is what you don't see. You don't see the 401k statements, the IRA statements, the paid off house. So these are things that I think people want to attain, but they also want to show people how successful they are. And I always come back to the quote: the quickest way to have less money is to try to show people that you have money.
Very true. Okay, so under our definition of defining what it's like to be rich, you talked about the top 5% based on income. So let's flip the tables.
I talked about the top 5% in income is about 300,000. So to classify as rich, you have to have an income of about 300,000. All right. To classify as wealthy, and this is just, I shouldn't even use the word classify, but U.S. household net worth for the top 5% is 2.6 million. So once you're around that 2.5, 2.6 million, that would put you in the top 5% of wealth in the U.S.
Does that surprise you that 2.6 million is the top 5% net worth?
I don't know if I have anything smart to say about that. I mean, if you unpack that, I mean, a large asset on most people's balance sheet is their home,
Mm-hmm.
right? And if you live on the left coast or the East Coast, that's probably what? Almost half of that amount. I mean, if you live in a nice neighborhood, have a nice house over 4,000 square feet in a yard, I mean, that's close to half of that amount. So no, if anything, I would think that number might be a little bit higher. And this is as of 2019. So it could be a little bit higher now. It might be 3 million now.
Yeah, that's kind of what I was thinking, is that being in the top 5% of anything, you're doing really well. And that number seems quite low to me to be in the top 5%. If I'm in the top 5% of best runners in the country, you're better than 95% of the population.
Right.
And so to only have your net worth be in that 2.5 to 3 million just seems, I don't know.
So Aaron, I have a question. So you're in your 20 somethings. Do you feel like your peers want to be rich or wealthy? Like if you ask that, or like just their actions, the way they behave, like, do you think they're trying to attain being rich or building wealth?
I think in my personal circle, I see both sides of it. And I think it's very obvious who falls on what side. I'm not calling anyone out here. I don't think that any of my friends listen to this podcast. But I think you can understand the intention behind the actions that you see. There are some people that are certainly more frugal than others that are openly talk about saving more, not wanting to spend on XYZ because they have different goals and things. But on the other side of it, there are people who say, I'll worry about that in, later down the line, or when I hit this milestone, then I'll start investing. I want to enjoy, the nice car now, that kind of thing. So I think I have a mix of both personally.
Yeah, and I feel like the pull of the social media culture to show how successful you are, all the stuff that you have, how happy you are, just propels people more towards that rich mindset, and they're not really building a sustainable nest egg. It's predicated on their active income, meaning having to work, having to earn to maintain their lifestyle, as opposed to the quiet, humble person that drives a 1995 Accord that's just maxing out their 401k, focusing on building their income, focusing on buying income producing passive assets. Like that's not really sexy, if you're doing that in the shadows. And I just feel like the social media,
Right.
Look at me culture, performing for your friends online, wins out at the end of the day.
Yeah, and we've talked about this a little bit before, but I think that social media also opens up people's eyes to what is possible. And I think that money is still kind of taboo. People don't really openly discuss, their income and other things that they have going on, at happy hour. So people kind of keep those things behind the curtain, but it wouldn't surprise me if people wondered, about each other, of what they have going on, or, you just bought this car or this house or went on this vacation. How are you affording that? It starts to kind of bring those questions up. And I think a lot of people don't afford it. they're going into debt in order to live a certain lifestyle and to kind of keep up with the Joneses.
Right. And we talk a lot about identifying the game that you're playing. And I'll use a personal example. So my idea of wealth, and I think there's many forms of wealth too. Like people hear wealth and they think about a balance sheet or money or a house or nice stuff. And that's part of it. But for me, true wealth is being able to do what I want, when I want, with who I want to do it, for how long I want to do it. Right. So many of my friends are surprised I drive a car that's 10 years old, that has a big dent in the side, the windshield's cracked. It's a 2013 Fusion, and it's a piece of crap. But I like it, and I think about buying a new car, and I ask myself, is this going to get me closer or further away from my goal of doing what I want, when I want, with who I want? And the answer is clear. If I buy a nice car, that gets me further away from my goal. So that becomes easy, and it becomes easy because I've clearly identified the game that I'm playing. I don't care about anything else. I don't talk to my peers about money. I don't get my cues from social media. I've clearly identified the game that I'm playing, which I encourage everyone to do because it makes your decision tree much more clear going forward.
Yeah, I think that's a great tip. I know you've mentioned it before, but when you have that clear kind of goal that you're reaching for, we've talked about, it's not goals that you should be working towards, but it's the kind of process behind getting to the goal is what you really integrate in your day-to-day life. But having that question that you could just easily ask yourself, should I do this? Yes or no? It's a little kind of decision tree. I like it.
Yeah. And we meet so many people that are stuck, like, hey, I'm not sure if I want to buy this house or invest the money or pay off my mortgage or invest the money or whatever, like buy a second home. And it's because they haven't identified what makes them happy. What game are you playing? And it's not anyone else's game. It's your game. What's your definition of happiness? And for me, it's freedom and being in control of my time. Once you identify that, those decisions become a lot more clear. And that's all I'm trying to say.
So let's talk through kind of some how-tos on how to become financially wealthy.
Go for it.
The first one, I hate that these are always on these lists, but it is always an option, is focusing on raising your income. I think a lot of people hear that and they just say, well, I'm in the job that I'm in and my income is what it is. What can I really do about that?
I mean, a lot of people focus on managing expenses, which I think is really important, but there's only so much that you can cut, right? Like you can't, like you're spending 50 grand a year, you can't cut that to zero because you have to eat, you have to live, you have to drive to work and all that good stuff. So there's a finite layer of expenses that you can cut off. The rest, you'll be destitute. Okay. So that's a fixed amount. Your income is infinite. In theory, you can make as much as you want. And in 2023, like I know people that make money in their underwear at 11 o'clock clicking buttons online. So there's side hustles, there's online marketing, there's trade, there's all sorts of things that you can do. So I always tell younger people, your human capital is your biggest asset right now. Focus on earning more. I think that's an underrated tip. And I know you hate it, but I actually like it.
No, I like it too. I think it's probably the people, I don't know, I go down forums a lot. Just like, I like to see what people say about personal finance and tips and things like that. Kind of like a deep dive on some subreddits, which is not always healthy, but I like to hear what other people's perspectives are. And I think some comments that I've read back to that focus on raising your income type of thing, they are negatively taken by people who are complacent and don't see other options. What's the next one?
Invest in a diverse set of income producing assets. So think dividend paying stocks or public real estate stocks or rental properties or things of that nature. Something that produces income without you having to do anything. And I would counter that real estate investing is not passive. It's very much active. So a lot of people that we've talked to have got into Airbnb rentals and apartment rentals and house rentals and things like that. And they come back and say, this is taking up a lot of my time. So when we say invest in a diverse set of income producing assets, just be mindful of what you're getting yourself into because what you think is passive might not be passive.
Yeah. Okay.
And then the last one is kind of along the lines of what I said, just identifying the game that you're playing. Plan for the life that you want, not someone else's life, not what your friends do, not what your brother does, but plan for the life that you want and what truly makes you and your spouse, if you're married, happy.
I think we've talked about this topic a lot in the kind of wealth building
space, how do you feel that this applies to retirees who have, quote unquote, built their wealth, but still want to try to define their version of being wealthy? Let's say they've just retired and they've got the next 30 to 40 years ahead of them.
Well, I think this applies mostly to the mid-career person or the younger person, right? As they look to transition, if they're trying to become rich versus trying to become wealthy. What I've seen in this with someone who's retired or about to retire is there's this feeling that they're rich and they spend like they're rich and they act like they're rich, but then you look at their balance sheet and there's not really enough assets to support their lifestyle. And it's easy to behave that way when you're working and you have an income coming in. But once you're done working, it's going to be really hard to replicate that. So the downshifting, being in tune with your expenses, being aware of where you're at, and if your current burn rate, your current spend rate continues, and let's say we get a market drawdown of 20 or 30%, you might not be able to stay, like your assets might not be able to sustain your lifestyle. So just framing, adjusting, understanding that you might not be able to create the same lifestyle that you did when you were working as you transition to a retired state.
Okay.
I don't know if that answers your question.
No, it does. I think that most of our audience is in that kind of retirement space. So I just wanted to have that perspective on the topic as well. Okay.
Well, and one thing I'll say too is from 2010 to 2021, markets have been really good, right? So if you're a retiree during that period, you've probably been accustomed to seeing your portfolio go up by 8-9% a year. And I think sometimes we can adjust our lifestyle when that's our baseline expectation. So if you're assuming your portfolio is going to go up by 8 or 9% a year, you might adjust your spending up because that's your new expectation for the market. What we've seen is as things have gotten a little uncomfortable the last couple of years, people haven't adjusted down. It's really hard to adjust down your lifestyle once you've gotten used to eating out and lavish vacations and driving a brand new car. So that's another pitfall that we've seen is lifestyle creep and resetting your baseline for higher market returns.
Okay. So the bottom line between the two is just to understand what makes someone rich versus what makes someone wealthy. Identify the game that you are playing and make sure that your actions reflect that.
Cool.
Okay. Thank you for listening to this episode of Blind Spots. If you have any questions, you can always send them to insight@pureportfolios.com, and we will see you in the next one.